Hello, everyone. Welcome back to the show, The Final Bar. I'm your host, Dave Keller, here at StockCharts.com. I want to welcome on my guest, Willie Delwiche. Willie's at Robert W. Baird, the chief strategist there. Willie, thanks so much for joining us. Really appreciate it.
Yeah, thanks, Dave.
You were thoughtfully sent us two charts ahead of time. Really appreciate it. The first one is looking at copper, what a lot of people would call Dr. Copper, and then the emerging markets index. What are you seeing here? How should we think about this chart?
Sure. So I'm glad you made the reference to Dr. Copper. That's how a lot of people think about copper in terms of an indicator for the economy. I think if we want to think about it with respect to emerging markets, we can actually put the PhD aside and pull out the CMT. Copper is a great indicator for emerging market stock market strength. There's a great signal there. They move together. As not just a kind of esoteric aggregate demand. There's actually a relationship there. So the thing I'm taking away from it, one, copper had a chance to break down earlier this summer, and it didn't. And that was in a seasonally weak period for copper. And so if something's not weak when seasonals say it should, then that kind of draws an alert in my mind and says, okay, well, is something changing here? And since summer, we've seen copper drift higher. Hasn't broken out yet, but it's working really hard at it. And if it does, and it's setting up to challenge its 200-day moving average, challenging the downtrend that emerged off of the mid-2018 highs, that would suggest that you're seeing this transition in leadership towards emerging market strength. And that's what the bottom clip shows, is that emerging markets are starting to act a lot better than what they have over the past 2 years. And so, you talked before about some of this rotation from a sector perspective. I think we can look at it too, U.S. versus international, and you're starting to see a rally that isn't just driven by what the mega cap U.S. stocks are doing, but broader in terms of U.S. strength and broader in terms of global participation.
This is such a great chart. You know, Willie, we've showed a chart a number of times in the last couple of weeks, just looking at the relative performance of U.S. versus the rest of the world and seeing that rotation. And obviously U.S. on a relative basis has done much better than international markets for the last couple of years. But in the last month or two, you've all of a sudden started to see this rotation where some of these, emerging markets and even developed markets are doing well. I mean, if you're an individual investor based here, how would you start to think about those global markets versus in the U.S.? How should they fit into sort of the overall approach, do you think?
Sure. So what I've been telling Baird financial advisors to tell their clients is now is the time to start thinking about diversification again. It's been quite a while since there's been a strong case for it. If you've diversified overseas in the last few years, you've gotten worse returns and more volatility.
That's right.
But you're seeing that change now. The data point for you, about 69-70% of S&P 500 stocks are trading above their 50-day moving average. 75% of Europe ex-UK stocks are trading above their 50-day moving averages. So you're seeing not just index level strength, but you're seeing breadth strength that is shifting overseas. And so what it says is follow that trend. Start to think about emerging markets. Start to think about Europe ex-UK. Start to go into areas that have been a little bit under-owned because they've lagged for a while. And maybe as we look forward over the next year, the next 10 years, then we'll be able to say, yeah, diversification does work. It does pay to follow strength into areas and not just be stuck in a kind of a U.S. large cap portfolio.
That's great points, Willie. Now, speaking of breadth, the second chart you sent us was looking at the value line geometric index, but then also looking at a breadth measure on the S&P. What are you seeing here? Yeah,
so if call me crazy, but I really like the value line geometric index. It's an end-of-day index, so you can't watch it over the course of the day. But what it does is it tells you what the median stock in the value line universe, so it's like 1,700 stocks or something like that, what that median stock is doing. And the story there has been, while the S&P has been making new highs, the median stock has lagged. And so you saw it particularly since the latter part of 2018. And as the S&P was making new highs earlier this year, the value line geometric index was making lower highs, and so and was actually making lower lows as well. Now, since September, that's changed. You've had you had a higher low in the value line geometric index in October, and now as we've moved into November, we're starting to take out some of those previous highs. And so, again, just like the global picture is improving, the domestic breadth and picture is improving, and that's you see that too in terms of the bottom clip there. More S&P 500 stocks are trading above their 200-day moving averages than we saw even just a month ago. And so if that breaks out above 78, 80%, again, that'd be another sign that this rally that we're seeing now, that the S&P 500 is getting a lot of attention for it, but it's much broader than that domestically, much broader than that internationally. And the way I would think about that, particularly from a domestic perspective, is not chasing the S&P here, but thinking, okay, if you've got broad support, then maybe some of these laggards, you talked before about materials and industrials, I'd throw financials in there as well. Some of those lagging sectors can start to play catch up. And so you get this rotation from tech, discretionary, utilities, real estate leadership, and into areas that have been kind of tossed to the side over the past year and a half. So financials, industrials, materials even. So it's setting up for a broad strength, even if it doesn't translate into this persistent trend higher in the S&P 500. It's a much stronger rally than we've seen over the past year, 2 years.
Willie, those are two solid charts, and I really appreciate the take, especially thinking about non-U.S. versus U.S. markets. Listen, thanks so much for coming on the show. Really appreciate it.
Yeah, thanks a lot, Dave.
All right, folks, that was Willie Delwiche. Really appreciate his take from Robert W. Baird. Two fantastic charts talking about big picture and certainly strength in the U.S. and abroad.